And while we're waiting, I think you should all check out Rob Smith's story on Jeffries, their exposure to first brands on the FT homepage right now, and basically just look up, like, any bank you work at, look up try to get a jump scare to see how much exposure it has to this first brands debacle from Rob's coverage. Okay. All right. So I'm gonna kick it off. My name is Max Frumis. I'm the global head of distressed and Lev Fin here at 9fin. Today we're going to talk about all aspects of the first brands implosion, the auto supplier that is now the biggest and most controversial bankruptcy of 2025, and perhaps the quickest evaporation of value amid allegations of fraud since FTX. It's still a fluid situation, with more questions prompted by every answer that we get. And here with me today to demystify the current state of affairs is a uniquely qualified panel of experts, starting with Rob Smith, the corporate finance editor from the Financial Times, an investigative reporter who has a track record of breaking news on the most complex off-balance sheet financing arrangements that can spell disaster for a company and its counterparties. Welcome, Rob.
Thanks for having me on.
Kat Corey, 9fin's head of bankruptcy coverage. Kat is a lawyer and expert in Chapter 11 who has been on top of every first brands hearing and docket entry. Laura Sheik, she's a 9fin distressed analyst, brings decades of legal experience, including as a restructuring attorney and writer with positions including most recently in the executive office of the U.S. trustee. Dimitar Vukdanov, a senior distressed credit analyst with 9fin, has an extensive history in restructuring, both as a financial advisor at a number of restructuring boutiques, including Houlihan Lokey, and as an investor out of the Goldman Distressed Bank Loan Desk. So let's just jump into it and kick it off with Rob. Your team at the FT has been the first on a number of things, including to report that there was something not quite right with first brands off-balance sheet financing. Can you go into how did you break this news and how did you start picking up the first brands coverage?
Yeah, thanks for having me on. This is actually quite a useful platform because, I know some of your audience are CLO managers, credit hedge fund managers. A lot of those guys hang out in anonymous Bloomberg chat rooms in which they swap market gossip. And some people I speak to share me screenshots of that market
and talk
gossip.
Smack about us.
Yeah, and I have seen a lot of APO fed the FT this story, and to help their short position. To set the record straight, I'm not going to go deep into sourcing, but we did not speak to Apollo Global Management prior to our first story on September 1st.
That was my first question. Everyone's saying, Apollo wanted to really get its short position to pay off, and so they fed it to you. But that's not the case.
Some people do the work themselves and do have independent sources in the trade receivable space. So yeah, there's a bit of background on me. I've been at the Financial Times for 8 years, but before that I was at International Financing Review, which mostly covers the new issue market. I covered the high yield bond market. I covered the high yield bond market in what I call peak QE insanity era, in which there were negative interest rates on Eurozone debt and there were very few defaults. But one of the most baroque situations I covered was a company called Abengoa, which did have a US subsidiary. It had a yield co. People might remember that structure. It's a sort of listed entity that held renewables assets. But basically, Abengoa did a lot of off-balance sheet financing, and it did a lot of reverse factoring. And what reverse factoring is typical factoring is when you discount your customer invoices and get cash from a bank upfront. So if your invoice was going to be paid in 90 days, you can get like 90 cents on the dollar on day one, right? Reverse factoring spins the whole thing around. And you go to your suppliers and you say, hey, my bank will pay you a discount. And then you owe the bank money, okay? But while as a corporate you owe a bank money, it is not included in your financial debt, in your financial liabilities. It's included in your trade payables. And this very key distinction meant a lot of people who perhaps wanted to guide term loan investors, high yield investors, that they had a nice and healthy leverage ratio would do this a lot, okay? And I won't go into all the details. Viewers who want to read more, I can send you some of my old stories. But Abengoa was doing about every trick in the book. It was also using a firm called Greensill Capital, which was at that time like nascent and no one had heard of it. And we can talk about that at the end. That turned into a big scandal. So with Abengoa, I reported a ton of stuff. There was one story of mine which sent their shares down 60%. That was fun. And it filed for bankruptcy protection about a year after I started covering it. Okay. A lot of the concepts on first brands are very similar. If banks don't roll reverse factoring lines, it creates a commercial paper-like maturity profile, right? You constantly have maturities. Abengoa was also doing short-term off-balance sheet financing at double-digit yield. This was all the while it was issuing 5-year debt at 5.75, 6, that sort of thing. So this was like my training ground. Like a lot of good journalists, you learn from experience. And flash forward a decade, by the way, to 2025, I'm sat at the FT, and a colleague of mine called Hortensia, she got a tip that a private credit fund had discovered something awry relating to its collateral. And there are a few details, but one of the words in the quite vague tip she got was receivables. So I was like, okay, this is my world. So I went out to a lot of sources I've built up in this world, and I said, this is very vague, but do you know if there's any fund that's caught something funny going on around receivables? There seems to be a fund involved, maybe multiple funds. There was a reference to a platform. So receivables are often like distributed on like fintechy type things. And there was a large corporate involved. That's all we knew. I sort of cast the net out. No one knew anything. This was kind of early August sort of time. And then 2 weeks later, one of the guys gives me a call. And I see his name flash up and immediately think like, oh, I wonder if it's this. And he goes, I'll anonymize some of this. He goes, Rob, the fund is X, the platform's Y, the company is First Brands Group. It's, a massive US auto parts firm. It's a levered roll-up. It also just had to pause a Terminal B issuance via Jefferies. But crucially, he said that this had billions of dollars more of off-balance sheet debt than the market realized. And in very British style, he bet me a beer that it would file for Chapter 11 by the end of October, which obviously ended up being conservative. So that was the tip that started it all, essentially.
Great to, and I will say at this time, the refinancing via Jefferies, the first lien portion of the term loan that was going to take out some of the debt was fully subscribed. And
Apparently, I've
they
heard this.
they
Yeah,
were
I've heard
just
this.
going out to try to get the second lien portion and shore up a little bit more to complete the refinancing. So, and the term loan was quoted on everybody's books, BDCs, CLOs, all the institutional investors that held it, term loan debt of over $5.5 billion in the 90s,
Yeah.
and up through and including August.
Yeah, I think so we published our first story on September 1st, Labor Day. And I believe the runs I'd seen was 95 on the first lien. And I can talk a bit about what was in that first story, actually, because there's a lot of elements
Yeah,
there.
yeah.
Yeah.
The one that made the big splash was the Apollo short.
Yeah.
But there was a first story out there that didn't send the market
Yeah.
spiraling, that actually started it all.
Yeah. So, I mean, maybe because it was Labor Day, maybe because reading is hard, that one had less of an impact, but it had
It didn't
Jeffries
have
in.
Apollo in the
It
headline.
didn't have Apollo in the headline, but it did have Jeffries in the headline, which obviously today have announced the $750 million exposure in Point Bonita Fund. So that's not Jeffries' balance sheet exposure. They've invested a portion of the equity in that fund. But that story is what journalists often call a flag planter. We know there's something big here. What can we write, largely based on public information, that can put a flag down and say the FT is looking at this situation? So we wrote a story that said Jefferies UBS O'Connor, which is the Chicago hedge fund that UBS has owned for over 30 years and is now selling to Cantor. And then also a firm called Katsumi, which is a joint venture between trading firm Mitsu, Japanese trading firm Mitsu, and Norwich Bank, which a lot of your viewers will know as Nochu, the erstwhile CLO AAA whale, right? These are the guys who had the biggest CLO AAA portfolio in the world at one point. So we wrote that. We revealed who was doing the quality of earnings review, because that's the key thing, that the TLB refi had been paused for a Q of E. So we revealed that's Deloitte. We had a lot more detail on its factoring. And then we had some detail on Patrick James. So Patrick James is the Malaysian-born owner of First Brands. He has lived in the States since, I think, his early 20s. So he went to college in Ohio. But we found that people didn't know a lot about the guy, which is interesting. He's 100% owner. He's the ultimate beneficial owner. And particularly in the term loan market, there was like, oh, I think people said, I think he was on an investor call, but we've never seen him. So like there'd been some interaction. And a lot of them, the first thing everyone said is like, yeah, we can't find a picture of the guy, which is, is just kind of funny. Like the guy owns a multi-billion-dollar enterprise and he's a bit of a ghost online. And one of the key things so that's me and Hortensia, my colleague, no one flagged this to us. We just did the classic, let's search Pacer. That's the legal filing service. Let's go to the Ohio court things, because sometimes those have additional filings. And we very quickly found that Patrick James had been sued by two lenders in the sort of post-financial crisis. And it was to do with a loan loss, but they also alleged that sort of fraudulent conduct had exacerbated their losses. And one of those lawsuits is very interesting, and I would suggest your viewers read it. It was a suit filed by Tri-State Bank, which is kind of a regional bank. I think it's like Pennsylvania maybe, but don't quote me on that. So their whole thing was to do with a sort of ABL type facility. And they said that when they got additional information on the borrowing base, they discovered like serious misrepresentations regarding accounts receivable, i.e. customer invoices, and inventory, which, given what's happened with First Brands and Chuck Moore's like first day statement, sounds a bit familiar. The key thing on those lawsuits was that they were dismissed, but the key thing on that was they were dismissed because settlements were reached. So Patrick James paid, one of the settlements is actually clear somewhat what the number was. One of them's not, so I'm not going to give an accurate number, but he paid a decent amount in settlements, right? So that was another thing, because later on, I discovered that some of the buy side had actually seen this, and they determined that because they were dismissed, they weren't relevant. I'm not sure if that was guidance from the company. I'm not sure, but it sounds like the classic thing of someone saying, "Oh yeah, those cases were dismissed." So yeah, we wrote the story.
We've got two lawyers on the call here, and and the fact that there's no conviction or concrete findings of fraud would suggest that there's no there there. As journalists, though, we can point out with tons of innuendo that a settlement is much different than a dismissal.
Exactly. It's something that might give a lender pause when there are also questions about the off-balance sheet financing of the guy's current enterprise. So yeah, that was the story we published on September 1st, and the term loans, I think, didn't really move. So yeah, that was the first story.
Yeah, and I will say, to give a shout out to Ninefin, we did break news about the quality of earnings review in early August. So if you wanted to know that the refinancing was not going well, the Ninefin is a good place to have been signed up, smaller audience. But the legwork that you guys did in the investigative journalism to get into this and report on it, I think was illuminating. And then that brings us to the Apollo short.
Yeah.
And so briefly, this was the one that really started things moving. Just kind of describe first the trajectory of this story, and then some of the aftermath of of how you think this short was constructed.
Yeah. So in the process of reporting the first story, within like, I don't know, 5 minutes of sort of casting the net out in credit hedge fund land, shall we say, someone, it was probably on WhatsApp even rather than the phone, someone said, oh, APO are short. And I'm like, oh no, I didn't know that. And then maybe within 10 minutes, like three other people had said, APO are short. So yeah, we found out very quickly that Apollo had a short position. As I said, we were like, let's make a conscious decision not to mention that and go to them on our first story because we don't want to like pollute it in any way. We don't want that. We want to be able to say we didn't speak to Apollo for the first story. And then we wanted a report on it. We thought that was really interesting. And I think another misapprehension from people in the market when they think Apollo planted the story is if Apollo planted the story, they would not want their name in a headline. If they've constructed a massive opaque bet against a company, which is separately a competitor of one of their private equity portcos, they do not want that headline. This was not a good headline for Apollo. It was not a good day when I called their media relations person and said, we're reporting this. So yeah, we very quickly found out that Apollo had a loan short, which, your viewers will know more about, but as a sort of specialist journalist, he was more generalist than them. I knew that that was weird and difficult, right? I have heard of them before. They're very hard to execute. They're very expensive to execute. We heard that it was conservatively had been held for at least a year. We heard some estimates longer than that, but that was the kind of, at least a year was like the baseline, which went through all of our sourcing, right? We try and report what we get multiple people on. Our sourcing at the time and the way we reflected it in the story was that it was bespoke CDS, loan CDS. Certainly, all my sourcing at the time was that it was synthetic. Interestingly, there's been a lot of reporting from you guys, from some of the other specialists, that the trade, at least at some point, might have involved delayed settlement short of loans on a sort of naked basis, which is, again, difficult, controversial. Like, I'm not clear if maybe my sources got it muddled. Some of my sources had spoken to Apollo about this. So you would think they're precise people. You would think they wouldn't say it was synthetic if it wasn't, but you never know. Maybe people fill in the blanks. But certainly the core point that Apollo had shorted this company's debt, held it for a long time, paid a lot in carry to maintain that position was true. So we published that story. And then people finally read it. And I believe the term loan traded from like mid-90s context, the low to mid-80s context off the back. And yeah, then we were away with everything that followed.
Yeah, that and to our knowledge, Apollo has not come back to any of us and demanded a correction on any of this.
No.
And on 9fin, we broke the news on how Apollo's asset-backed financing arm, Atlas, had actually gotten an early look at some of the asset-backed financing for First Brands around the time that they had put a short position on. We found that interesting, and then 9fin's gone into a legal analysis on what is actually considered trading on MMPI in the loan market, and
not a security, right?
And yeah, exactly. It's all very squishy, and the naked shorting of loans is more common than one would have realized. Like if you're big enough and you go through the right banks, you can just sell a loan that you do not have and then cover when it goes way down. And that is apparently much more common than I had realized at the very least. So and we want to get to now the rest of the group here as that reporting and a number of other events led to the rapid deterioration of the loan, and then ultimately all these off-balance sheet facilities that are, I think usually 270 days going to cash on delivery, right? Or 60 days, to the point where there's a huge liquidity crunch and First Brands had to file for bankruptcy. And so here we are, and this is this massive chapter 11 that's, a full free fall with a lot of things going on. Kat, you've been following this, from all the filings that come on the docket and the first day hearings, and just put out a story articulating who's who in this bankruptcy. Can you walk us through all the stakeholders who have been disclosed and spoken up in the bankruptcy and who hasn't?
Yeah, certainly. Thanks, Max. Yeah, so first, obviously it's key to realize there's two separate groups of debtors, starting with the debtor entities. First, you have, the First Brands operating group debtors, which were the second group to file. And then you have your SPV debtors, that were the earlier group. Interestingly, between the two, they have the same bankruptcy counsel, they have the same boards in charge, they have the same investigation committee in charge. But I think notably, they most likely have different desired outcomes that could be best for the two different groups. And it comes to mind the franchise group bankruptcy. They had a similar fight between their operating and lending co debtors, and that was until it settled. That was, if you followed it, it was a very interesting situation. The different interests between the two different types of debtors. After that, you have the ad hoc group. They're represented by Gibson Dunn. Obviously, they were involved before the bankruptcy filed, part of the refi that fell through. As it came out from Greenberg during the first day hearing, he gave a little bit of a background into their involvement with the dip.
Scott Greenberg, the
Scott
preeminent
Greenberg, sorry, yes.
LME,
Yes.
creditor attorney.
Yes. So it was interesting. The debtors you mentioned that the debtors had kind of indicated that they were considering kind of an in-court syndication process to get the dip allocated, the full amount of the new money. But a cohort of the lenders in the ad hoc group kind of banded together and rounded up the troops, so to say, to get the dip fully allocated before they even filed. So his run through during the first day process was quite interesting to hear it from their side, as opposed to how the debtors told the story of the month before the bankruptcy. The next group is the SPV creditors. These are the lenders, with the factoring facilities and the SPV debtors. Some big ones, Evolution is there with Proskauer, and Onset with Morrison Forster. They were at the first day hearing. Onset, I thought it was interesting how they approached their issues with the case so far. They're they're a fun blend of a lender slash equipment lessor. So they have some interesting issues other than just pure lending, but they had a fun comment that, they're the debtor's biggest debtor or creditor. They have over $1 billion owed to them alone in this case. So their interest during the first day hearing with respect to the interim dip specifically, and a little bit of the cash management, was, it came out with this investigation committee that there's been some dual collateralization of assets. There was defaults on the factoring before pre-petition. So their interest, was let's keep the status quo, right? They want their money, they want their assets. But in the interim, let's make sure that nothing's being given to the dip lenders that shouldn't be. So essentially, they all got stipulations with what I'll call a status quo situation to maintain everything while the fights are now probably happening quite rigorously in the background, I would assume, on whose collateral is what and sorting that out. Next up, the ABL lenders. They didn't say too much at the first day hearing. Obviously, they're in an interesting situation with a dual collateralization. They were technically pledged someone else's collateral. They didn't know that, obviously, but and then they have provided funding to the the operating debtors based on that pledge. So they're definitely involved in this this SPV discussion and how it's all going to get sorted out. They weren't particularly pleased with the mechanisms that were being used to appease the SPV lenders in the dip order, but Judge Lopez, I think he was pretty clear in his decision that this dip is going through, so figure everything out. So at the end, everyone was able to come to a quick resolution on it to at least move to the final stage of the hearing. And then finally, a party that hasn't appeared because it doesn't exist yet, the UCC. Obviously, in the background, the U.S. trustee works really hard to form these committees, sending out letters to ask if you're interested. I'm guessing from past experience that the interest in this committee will probably be rather large, which puts a little bit of a task on the U.S. trustee to pick the creditors that will bring about the best representation of every type of unsecured creditor in the case. And then as I see it, the UCCs, once they're formed, there's going to be kind of two paths that this case could go down. One could be they could be less litigious, work with the debtors and the ad hoc group and kind of join that cohort and make a settlement and move forward. Or, and honestly, in my opinion, this is more likely, there'll probably be more of a litigious approach. they're going to want discovery. They're going to want to know what happened, and maybe fight tooth and nail to get more money for their constituents. This case, the DIP maturity currently is a 9-month case with 3-month discretion of the debtors to extend, and then further discretion with at least 50% of the DIP lenders to extend after the year. So I think, obviously this is minimum 9 months. I think it's going to be longer. And I think there's going to be a lot of interesting fights as these parties start to interact more openly in court. And finally, the last party involved is Patrick James, but we'll get to that a little bit more later.
Okay, so and Rob, are you willing to take the under on the 9 months for another pint?
I feel like I'm net negative pints at the moment. So
okay, all right. Well, maybe not. Maybe not.
I'm not gonna hand any more out.
We'll take some bets at the end. Yeah, and thank you, Kat. Like, and if anybody has been hired for the UCC Council, let us know before it hits the docket, please. And Kat, you described the ad hoc group advised by Gibson Dunn that is providing the DIP. And the DIP has some very interesting features in it, and Ninefin's been reporting on the non-pro rata nature of some of these features, including a very large 10% anchor fee for a subset of that ad hoc group that has not yet been disclosed. In addition to that, there is this new money portion, which is 1.1 billion, and then there's an additional 3-to-1 roll-up of 3.3 billion. 1.5 billion of that has already been rolled up on an interim basis, or approved to be rolled up on an interim basis. In fact, we've heard that the actual new money has not even been gathered from the DIP participants, since there's so many changing of the funds who own the term loan. But the 1.5 billion approved on an interim basis is essentially supposed to be allowed pro rata, right? And equally for all the ad hoc group as participant, which is like effectively everybody at this point. And then there's this holdback portion, which is 1.8 billion that has not yet been approved, that from our understanding is the lenders are going to be permitted to roll up portions of their debt that are not pro rata. So if you were on the inside, or if you're large, or if you got the right connections, you're going to be able to roll up a higher proportion of your term loan into a DIP debt that is pari to the new money. Whereas if you came in late or are a holdout, you won't be given that same opportunity. We can get into that. Not all of those allocations have been disclosed, but stay tuned. And the way that this is played out has brought up some questions as to whether or not this DIP could be challenged by other parties. And Laura, you've been doing an excellent job of looking up precedent where unequal treatment for similarly situated creditors in the context of a bankruptcy has been challenged. Can you go into those cases and how applicable they are here in First Brands?
Yeah, absolutely. So, and just kind of as a kind of a ground to set the groundwork a little bit. So the significance of the roll-up, obviously, is that basically we're converting what was pre-petition debt into post-petition debt. And so obviously having that requested $3.3 billion of first lien term debt converted to post-petition debt that will be paid first before any other creditors is obviously very significant benefit to the parties that participate in that. But kind of turning to the controversial nature of some of the non-pro rata treatment that Max mentioned, specifically the 10% backstop fee that's going to the anchor group. So this backstop was offered, as I think has been mentioned, to kind of a select group of first lien and second lien term lenders represented by Gibson Dunn. Since the formation of that anchor group, it sounds like pretty much all of the first lien term lenders have signed on to participate in the DIP. So there is kind of what results from that is somewhat of an unequal treatment, right? Because the anchor group is going to receive a backstop fee under the proposed final DIP order, and those first lien term lenders who aren't part of that group will not receive the backstop. So very recently, in another case, also before Judge Lopez, Converge 1, there was somewhat of a similar situation, except it was a backstop of a rights offering. So like exit financing through a rights offering. Pre-petition, a majority group of lenders had entered into a restructuring support agreement with the debtors. And under that RSA, which was turned into a prepackaged plan, they had a right to backstop a rights offering under the plan for which at a significant discount. Minority lenders who were not invited to participate objected at plan confirmation, and bankruptcy judge Lopez actually approved the plan. This was in May 2024, so over a year and a half ago. And recently on September 25th, the district court for the Southern District of Texas reversed and held that actually that backstop was resulted in unequal treatment of similarly situated creditors, which is a requirement to confirm a plan. And it also violated a Supreme Court precedent, LaSalle, which holds that exclusive kind of these kind of opportunities that are given by an existing debt or equity holder and not offered to, not market tested are not allowed. So they violate the absolute priority rule as well as equality of treatment. So, so given that this decision has just come down from the Southern District of Texas and it was a decision coming out of a bankruptcy court that's overseeing First Brands, it seems like.
And the same judge.
The same judge. Yeah, not only the same court, but the same judge. I think that this particular backstop, which was not market tested, was not offered to all of the holders of first lien term loans. It's definitely going to be an issue that I'm sure, if not the parties, the judge will raise at the final dip hearing, I would imagine. So a couple of other kind of interesting things about Converge One. Another decision that the court there relied on was the Fifth Circuit's decision in Serta Simmons, which held that an indemnity right under a plan that only benefited certain creditors in a class also violated the kind of ban of unequal treatment of creditors. So we have like two precedents, both within the Fifth Circuit that are kind of like frowning on unequal treatment. And then kind of the non-bankruptcy issue that comes up is kind of these sacred rights provisions that exist in pretty much all term loans that require pro rata payment of creditors, right? So that of the lenders holding interest under those loans. So both the backstop and the roll-up arguably violate those sacred right provisions. And we have seen this come up in other cases that 9fin has covered. Specifically, there was a situation in my American Tire in November 2024 that we covered where the bankruptcy judge actually, and this was in Delaware, bankruptcy judge Craig Goldblatt raised an issue at the final dip hearing saying, listen, this is a non-pro rata roll-up. And I'm going to require that you reserve the rights of the non-participating lenders to challenge this later. So the parties, rather than include that reservation of rights, they decided to just take out the non-pro rata roll-up feature of that final dip. So I think there's, a lot to be seen as far as like who challenges this dip. And I imagine the minority, the lenders who are not participating in the backstop fee, I imagine they will object or the judge will raise it himself.
Okay, but Laura, on this real quick, the lenders not participating though are part of the ad hoc group, like that aren't part of the anchor group are still part of the ad hoc group. So right, Converge One, American Tire, right?
Probably not the term loan lenders at this point. Probably other creditors might object but like, yeah, I think they got them. I think they got them all.
Yeah,
right?
they're pretty close, right? And I think the key between the others is that there were like extensive excluded lenders that took offense, right? In American Tire and Converge One. And I feel like we're maybe lacking that aspect here in First Brands with respect to the ad hoc group. Participation of the dip was open to everyone. The anchoring group is kind of I don't want to say a reward because that's not the right word, but kind of like a a thank you present in a sense for getting the ad hoc group on board to fund the dip. They were going to run a syndication process and they were able to avoid it. So that's why they're rewarding it. So I feel like there's objections to be made, but I'm not sure that it's going to be the other lenders that are taking offense to it.
Yeah, we'll see. There's no minority group it got. There was one with Glen Ager that got looped in. There were others that were holdouts for a little bit. And from our understanding is it's like 99% of the first lien holders have signed up in one way or another. But the difference between the best treatment and the worst is including the 10% anchor fee is the non-pro rata kind of like treatment of the holdback portion could be as much as like 35, 40 points different in recovery. So like that brings us to Dimitar. We're trying to factor this in, and there's not enough disclosures on the bankruptcy docket to correctly get the recovery estimates in this waterfall for this one class that even within that class has disparate treatment. But we take a stab at it anyway. So Dimitar, could you go into there's already been huge losses by funds that sold in the 50s, 40s, 30s. And, and Nine Fins reported on a number of those, including, CIFC, big institutional holders, CLOs dumped it, distressed funds have gotten in, and now maybe there's an opportunity for outsized returns if it's not all a house of cards, which, we never know. Could you describe what's gone into your waterfall in determining what could be the recoveries here for different classes?
Yeah, sounds good. So last week we put out a piece covering kind of an illustrative waterfall, various kind of scenarios looking at different EV/EBITDA multiples as well as EBITDA ranges as well. And the important thing to note is that analysis, basically we're looking at the first lien, the second lien obligations along with the new dip and the roll-up. What we're not including is all the working capital obligations. So that's the LBL facilities, the SPV structures, the factoring facilities, because those are going to be handled separately, right? They have their underlying collateral of the inventory and receivables, and if that's not sufficient, they'll have deficiency claims that are coming into this piece of it. But right now, it's not clear exactly how that's going to play out. So that's kind of what we did. What the analysis also captures is the full implementation of the dip. So the 1.1 billion of new money coming in, the full 3.3 billion of roll up of the pre-petition first lien obligation. So we're reflecting that. And basically what you see is in the scenario, what we were calling scenario 2, at a 4.5 times multiple and a 1.1 billion EBITDA range, the new money is effectively going to be recovering 120 cents. And that's because of these structuring fees, right? It's the anchor fee, 5% entry and exit fees. So that's kind of where they're coming out. If in a scenario where EBITDA is a little bit lower, we show like a 15% diminution for a bankruptcy process, or the multiple falls to 4 times, you will have a scenario where the dip is impaired, the new money that's coming in. So that's interesting to note. And then in terms of the unsecured claims, which will kind of go through the full waterfall, there really won't be any value going to unsecureds unless the multiple is above 6 times. So that kind of gives a framework in terms of how the dip's going to do, what the implications are for the new money and the roll up. And then we also show kind of what happens to the second lien and the remaining first lien as well.
It's a really, really great report. Anybody who wants like the illustrative waterfall with the caveats that we just don't have all the information here, let us know. But it all relies on there not being a massive amount of the F word, which Rob we're going to get into right now. So like there's no findings of fraud here, and like the court, we did note in our story that the same counsel for Patrick James and in First Brands also represented a gentleman by the name of Lex Greensill. And Rob was known for breaking that story wide open. And to this day, there's still been no actual findings of fraud. Rob, can you explain like maybe some of the similarities and differences between First Brands and Greensill?
Yeah. I think the lights just went out in my room, by the way, because I've been sitting here for too long.
Derek,
But,
yeah.
if it will add a
Patrick James coming
shadowy,
after you.
sort of misty air to my speech. Yeah, so let's be clear here. Yeah, there's been no findings of fraud yet at First Brands. What we do have is Evolution turning up in court, or rather it's counsel, and saying we are a victim, someone took our collateral. We have Chuck Moore investigating, or rather, sorry, Chuck Moore announcing a special committee, which is appointed by the debtors.
From Alvarez and Marsal,
Yeah,
the CR.
yeah. The committee, which is independent but appointed by the debtors, so not an examiner, right? That's a key nuance for you Chapter 11 nerds. They're investigating whether invoices have been pledged more than once, right? That practice is often called double pledging, something that is alleged to have happened at Tricolor as well. It's a bit of a misnomer though, right? Because double pledging, you could be triple pledging, quintuple pledging, you could be pledging, you could be having a lot of fun with those invoices. And I think one key thing, maybe for the guys in term loan land who aren't aware of this stuff, you might think like, oh, well, double pledging is probably not so bad because, this all happens on a platform and they're checking things. People are probably filing UCC1s, that kind of thing. It's probably going to be minimal. I can tell you that the range of structures in factoring and the range of checks that happen at invoices are wide. And at one end of that, the lack of checks are wild. So you can have factoring where you assign the receivable and the end customer gets notified, right? So they know that they're paying the bank. You can also do structures broadly under the umbrella of silent factoring, where the customer is expressly not told about it. In those scenarios, you are supposed to sample the invoices to check. But if the invoices are being factored across multiple platforms, which they were, so some of those firms named in the Chapter 11 petition, they are platforms through which other investors have invested. Raystone, Orbion, I believe LiquidX is in there. And you can imagine a bit like Archegos and its prime brokers all one day realizing, oh, wait, we thought we had, the whole exposure, but there's sort of 10 other banks on the street whose primes have exposure. Some of those platforms might be having that moment, right? And those invoices are not being checked across those platforms. There's not some universal blockchain which is checking this stuff. And I think in terms of like all the dip recovery analysis, and we had some big caveats, but it's not just a collateral issue, it's an earnings issue. If you're doing things around invoices, what are those? That's your incoming from customers. That's your revenue, right? If you are doing, which they have not disclosed yet, but is often seen in these sort of situations, something called fresh air invoicing, you are simply issuing invoices in which the underlying trade didn't exist. You can, for example, do this by setting up a related party company as your customer or supplier and not having it disclosed. That is a classic trade finance fraud. I'm not saying that that's happened. I'm saying I've seen it before. That means your revenue number is garbage because you are literally spinning a money printer that is spitting out invoices. So all of that EV analysis, everything people are doing, you cannot, you need to, it's not just about haircutting it. It's like, are those numbers even usable? And then you have on top of that, the collateral. There's a lot of inventory debt here. Inventory, if it's done correctly, a team of people go to a warehouse and they check the inventory against something known as the perpetual master list. Has that happened? Do we know? Is the inventory there? There's all sorts of things that can happen when these situations go bad. And then another key point, if you read the DIP credit agreement, you will notice that there's a stipulation that the borrower shall maintain the big 7 factoring programs on a best efforts basis. So they are saying that they are going to try and maintain some of their factoring lines through the chapter, right? They're saying that that is important for them. Do you think that factoring banks are going to be inclined to maintain those lines? Maybe they'll have more confidence now guys like Chuck Moore are involved. Maybe not, right? So EV can melt when there's a working capital unwind, okay? It creates a bank-like run effect on your working capital. And even under the stay power of a Chapter 11, This is financialized trade credit, okay? That's the key difference here. This is something that's constantly moving. So I think some people are aware of this, but I think maybe some people are still viewing this as distressed company, a bit messy, maybe we have to haircut that. That was not really an answer to your question about Lex Greensill. I will now answer your question about Lex Greensill briefly.
Yeah,
So-
and you know, like that, I like, but this is leading up to exactly what the issue is at heart. And so we're going to get into this, and afterwards we're going to take questions. So if anyone has questions, just put them in the Q&A that should be available at the bottom of your screen, and we'll get to them after we get the lesson on you know, the lessons learned on Lex Greensill, which is right, have good attorneys and be based in the UK.
Well, it's mainly, yeah, have good attorneys is definitely one. He's spent a lot on legal fees, but it is primarily be based not in the US. And, you know, Trump and the sort of perceived attack on the judiciary might be changing things, but the US is typically a bad jurisdiction to do white collar crime. Europe, and I use that in the broader sense, including the UK, which is not part of the EU, is an excellent jurisdiction to commit financial crime. Going back to my experience of covering the European high yield bond market, there were several companies that did a new issue, and maybe 18 months after the new issue, the money went missing. I can only think, and I'm not going to say which one, I can only think of one person out of that sort of new issue cohort that did funny things who went to jail. Coming on to Lex Greensill. So for those who don't know, Lex Greensill was the founder of Greensill Capital, which was a factoring firm that pretended it was a fintech firm and got billions of dollars in funding from SoftBank's Fizzing Fund. It had a $10 billion set of client sort of funds at Credit Suisse that it got to play around with. And Greensill collapsed. A lot of that 10 billion went missing. There are allegations and investigations of fraud into some of the underlying borrowers. And Credit Suisse collapsed 2 years later, had to be rescued by UBS, partly due to Archegos as well, but partly due to the fact it lost client money. And those clients, by the way, included Qatari princes. The old joke of like, where are the customers' yachts? These customers had yachts. So Lex Greensill himself, right? So he's the man at the center of this. He got very close to our former Prime Minister, David Cameron. We exposed that David Cameron had lobbied for sort of a COVID loan bailout of Greensill, to put it in broad terms. David Cameron was very embarrassed, but then he was later made a lord because that's how the British establishment works. Lex Greensill has not been charged with fraud. I believe it's fair to say he's been accused of fraudulent conduct in civil litigation, but particularly from insurance firms. But again, that's not proven. The one thing he does have going on is that the British government is trying to disqualify him from acting as a company director. And that process is ongoing. There should be a trial next year, and that will be 5 years after Greensill collapsed. So I actually got to speak to Lex Greensill personally for the first time this year in 4 years. So the last time I spoke to him in 2021, he accused me of a significant amount of character assassination, which he didn't say was off record, so we printed it. And then the next time I saw him, he was in the dock, he was in the stand, but it wasn't his trial. It was a dispute between Credit Suisse and SoftBank, and he was giving evidence. You know, UK courts, maybe like American courts, are very sort of close proximity places. So I ended up having a very brief chat with him. So yeah, Lex Greensill there's no criminal, there are potential, who knows, but there's no current live criminal charges against them. There's a kind of minor government-led, kind of almost like regulatory thing against him.
Yeah, so the worst thing that could possibly happen is he could be stricken from being a director of a UK company, given the current processes right now, and the investigations have turned up nothing. Maybe a shout out to his lawyers, maybe the venue, and maybe he's you know, he's pure as driven snow. So we'll start taking a couple of these questions here. Since these off-balance sheet factoring facilities aren't particularly unique, are there other companies or industries that could have significant undisclosed supply chain financing? Anybody jump in, but Rob,
Yeah,
what's the next First
no,
Brands?
no, no, no. I'll jump in very easily on this because we know who First Brands customers are. A bunch of them are mentioned in today's statement. So there's Walmart, right? But there's also O'Reilly, AutoZone, Advanced Auto Parts, right? Those guys do a lot of factoring and reverse factoring. And a lot of them are IG rated, although double P plus, they're kind of crossover kind of names. But they do a lot of factoring, including with First Brands. So there's people I know in this market who have provided supply chain finance facilities to these companies where they've been paying First Brands, right? And Moody's actually did Moody's have been quite good on this. I know we like to bag on the ratings agencies, but they've done a lot of work around factoring because they've seen it's important. There's a guy called David Gonzalez there who's like a pretty smart guy. They did some research, I think it was last month, which I've got in front of me, quote, auto parts retailers are the heaviest users of supply chain finance facilities, end quote. And it says that due to the relatively slow turnover of inventory, they, quote, manage working capital aggressively, end quote. So yeah, basically, little bit spark plugs, carburetors, they can sit on your shelf for years. They don't have a sell-by date. You hold a lot of inventory because you don't know what your customers want or need. That situation is rife for financialization. So although those companies have strong balance sheets, they will have a lot of cash on balance sheet. I think if people have exposure to them, it's at the very least worth trying to understand and get to grips with both their interaction with First Brands and their use of working capital finance more generally.
And so First Brands counterparties, right? Auto parts suppliers, like a number we'll probably put screens of these names, in various reports down the line, but we're not going to go name them one by one right here. So stay tuned. There's a Abengoa question here. I think the answer's right, like, it's a good parallel. But to the extent that Abengoa engaged in fictitious repo trade transactions to create fake payables that were funded on the receivables exchange, is that a possibility here?
So the thing with Abengoa, because I don't want to misspeak, and there's a lot which came out, and there's a lot that didn't come out. There was, I believe, a criminal investigation into the auditor and also the CEO, but I don't think they were charged. We're going to assume for our purposes they weren't charged. There was a lot of funniness with Abengoa was incredibly financialized. It had a lot of related party transactions. I don't believe it was ever publicly disclosed that they did double pledging and that sort of thing. I think there may have been sort of more advanced forms of obfuscatory behavior. I think where Abengoa is relevant is it played fast and loose with non-recourse structures. So one of my key stories on this was that they raised a bond that had the same guarantee structure as their sort of main bond issued out of a new box, but then they classified it as non-recourse debt. And they used some like incredible voodoo from their auditor to justify this. And it was complete nonsense. It had a hard guarantee. And with some of these inventory SPVs, right, that have since emerged, so Carnaby, that construct, and we know that Carval, and I think we mentioned Onset earlier, the kind of Utah-based, seems to be more of a broker or an intermediary are involved. So we know from the filings that some of those facilities had a holdco guarantee, so First Brands Group, that they had the same ultimate chain of ownership through Patrick James's LLCs. We also know that they did business with the operating company. I believe that these entities were not disclosed in the accounts, and certainly the consolidation that investors got did not include them. I think that's obviously going to be a key area people are going to look at and question now, right? Why didn't we know about these entities? And I think that's where, for me, like the Abengoa echoes really come in, because suddenly people realize that Abengoa, actually a chunk of your non-recourse debt has guarantee from the entity in the restricted group in which I sit. So that's where the echoes come in for me. Yeah.
Okay, that's great. Yeah, so we're gonna one more time. There is a good question to repeat the mechanics of the invoice fraud, which is that I think is essentially fresh air invoices or invoices basically that are not that are created based on they're fictitious, they're fraudulent, right? It's just like it's basically you're writing an invoice for a transaction that has not happened. Is that correct? And could you make it like more succinct and clear?
I can explain this from a case study. So Greensill Capital provided a lot of funding to a chap called Sanjeev Gupta, who rolled up a bunch of steelworks, so another industrial business. And in our reporting on Greensill, you don't have the transparency of a Chapter 11. So through sources, we got hold of some of the invoices that Sanjeev Gupta's company had factored with Greensill. And then we rang up the company named on the invoices. Some of them were based in Germany, some of them were commodities traders, we'd all know. And a lot of them came back and said, it's not just that we don't recognize this invoice, we have never done any trading whatsoever. Now, Sanjeev Gupta, his company is under investigation from the Serious Fraud Office, which is like the DOJ here. It's dragging on, nothing's gone clear. He had a sort of excuse around this. He kind of, the gist of it was that Greensill allowed him to factor invoices for trades that hadn't happened yet, which is quite astonishing. But yeah, fresh air invoicing is when you just print fake invoices, essentially. And there's been no disclosure that this has happened at First Brands, but it is a common form of trade finance fraud.
And we're here at the end. This has been really illuminating, and there's so many more questions that I have and we have, but like right now. So stay tuned to both the FT and 9fin for coverage of this situation and similar situations. So right now we're going to do a rapid fire round of what each of us thinks is going to happen next. Let's start with you, Kat. What do you think is going to happen next in First Brands?
Motion for examiner by the SPV lenders ahead of the final very robust dip hearing.
Okay, Laura. Oh, rapid fire. Okay, so we'll go to Dimitar.
Yeah, I mean, I think we'll start finding out more about all the disputes between the SPV structures and the ABL creditors about, some of the shared collateral and kind of what's happened, who has it, who doesn't have it.
Okay, Laura.
Thanks. Sorry, I was on mute. So I think that the Converge 1 decision is really going to give bankruptcy judge Lopez pause before approving that 10% backstop fee that won't be shared with all of the participating lenders.
And Rob.
Yeah, I mean, I don't know about next, but I think it's notable that Patrick James is still at the company, right? Through the bankruptcy. There's that, I think it was an LBJ quote about J. Edgar Hoover about better to have him in the tent pissing out than outside the tent pissing in. But you may imagine there comes a point at which having Patrick James inside the tent is no longer tenable, is what I'd say.
And I predict that you're gonna read about all sorts of news first at the FT and 9fin. So thank you all for joining me, and Rob especially. Really wonderful reporting. You're doing a great service by bringing all this to light. All right, and until next time, please go to our websites and follow up for recording of this webinar, which will be available to 9fin subscribers and subsequently to everybody. Thank you so much.